And with this webinar, webinars on FX trading. More. Today is June the 4th, and the title of the money, dump money, and seasonality in the market. And as you know, I concentrate mainly on trying to identify the effects of modern algorithms and smart money on price. And I believe, and I also believe I have a proof that there are very active algorithms that are very active on all time frames of high volume markets. I will keep adding tools, and I'm looking at the moment seasonality, and we'll talk about that later on. Now, this presentation, it's pretty long, and we'll be looking at charts, as you know. In my webinars, I look at content, and I always look at charts as well, because what we learn needs to be put into practice. So we'll look at several charts as well. All right. So as you know, all the charts I will review are for and all the content of this presentation is for your information, and this material is to be considered for your general information, and you should always rely upon a substitute you should not rely on them as a substitute for your extensive independent research. So if you are watching this presentation, please pause it here and read the disclaimer here. I want to talk a lot about myself. I'm a premium contributor to FX Trade for almost 3 years now. And I'm in the market since 2001. And I've collected over 20,000 hours of market exposure. The people I would recommend you study with are Van Tarp, Ivica Juracec, David Asley, Joe Di Napoli, and many others that have influenced the way I look at the markets. I also have a website, fipstocketrading.com, which I'm renewing these days. So you want to have a look at that, you'll find a lot of information there. I happen to work also with IFTA, the International Federation of Tech Analysts, and particularly with the Italian chapter and the Canadian chapter, the CSTA. These are some of the organizations I'll be working with, and that's myself, if you don't know me. This month, I'm celebrating an award I received for a research paper I wrote back in 2009, and then recently I have published an excerpt of that paper on the Italian journal of the Italian Society of Tech Analysts, as well as the Canadian Society of Tech Analysts, which I published in 2016 last year. Now, if you want to look at that paper, you can download it here. You can also go to the CSTA, which is a non-profit organization and part of the International Federation of Technical Analysts, and you can review it. But the Jack Frost, it's an award that has been accepted by the Canadian Society of Technical Analysts, and in the last 35 years has been presented only a handful number of times. Last year it was presented to Martin Brink, which makes me very, very proud to be in the same group of people who have contributed substantially to technical analysis, and that's me receiving the award, and the award was for this research paper that fills a gap in current research, and it links money management, so money and risk management, to the achievement of trading goals. Again, if you're interested, you can read that. For those of you who do not know Jack Frost is an unbelievable character. He did so many things, and among those, he was also one of the contributors of the Elliott wave theory. And he famously written, technical analysis, somewhat like sex, timing is everything. Okay, so an exceptional character, great contribution to tech analysis, very, very proud to be in the same group, not in the same league, maybe, but in the same group. So I'm just celebrating this month, and I want to invite you to get the free course at winningwithalgos.com/start as part of this celebration. This is an 8 hours seminar that I gave to one of the universities here in Canada, and I think you'll find it very, very interesting. I also wrote other papers here. I'm not going to spend time on that. If you want to go on the website, fifthstartrading.com. So let's get into the content here, and I try to simplify the way I trade and teach how you can trade easily. Now, in this set of two presentations, and this is part one, I'm going to talk about the main market players, who they are. I anticipated the smart money and dump money. My beliefs about price in modern markets, and I believe algos are very real, and they can have an incredible effect on price. And the good news is that we can identify the areas where algos might come into play and participate with a lot of time in advance, sometimes on larger time frame, weeks, if not months, on daily, could be weeks, on days, on 4 hours, could be days, or many hours, and so on. So we look at how to model the effects of algorithms on price structure, so basically how to identify this area in advance. We look also at dump money, and I use the main tool, it's the moving averages, and a lot of people still using moving averages, believe it or not, even professional traders in certain settings. Obviously, artificial intelligence is getting and will be getting more and more volume as we proceed, and maybe we'll talk a little bit about that as well, what it means for us as traders and retail traders. And then we look into seasonality for confirmation, and as usual, I give a lot of examples, and we look at specifically SP 500, where the price is going, and US dollar Japanese yen as well, where's the price going, how we can apply this information for the next trade and understand what's going on to price, what's going on in the price. I have a timing technique, which is a proprietary timing technique, Fibstalking timing, which I use to test the participation of smart money. There are also additional techniques that use the moving averages, believe it or not, to time entries against dump money. Okay, and we will talk about that as well. So I hope this is going to be interesting. How many of you have you ever heard about smart money and dump money? Give me a yes if you did. Yes, no, maybe. There are two players in the market. Anyway, there are at least two of them. There are many in reality, but we can only try to model the market and give structure to market using simple or simpler tools as well. So Algi is saying algo design, very good. So probably Ali is involved in designing algorithm. Is that prototyping algorithms? That's very good, Al. If you want to share the tools you use, please do. Meaning how you write your code, how you test it, and so on. Please share. So there are many players, but at least two groups, smart and dump money. The way I look at them is that the smart money knows what they're doing. Basically, large banks, professional traders, program trading algorithms, artificial intelligence. I know of a group working in Alberta, here in Canada, the University of Alberta. Whereas the artificial intelligence department is collaborating with major banks in Canada in order to develop algorithms using basically machine learning to adapt to markets. The dump point, on the other hand, is the regional tech analysis crowd, trend following, discretionary, and I don't really have a clue what's going on and what this market is, but being a trader is cool, and you don't want to be in that category. So, of course, smart money or dump money do not win or lose all the times, but I strongly believe that smart money initiates and leads market moves, while on the other hand, dump money obstacles or follows. They can only follow market moves that were initiated by the smart money. So often, for this reason, the dump money is either is wrong or it's late, so it lacks price. Analysis sharing, yes. Still need to expand my knowledge on that domain, but statistics and programming seems to be a good start. They're definitely a good start. This technique, like everything else, any other technique or trading concept, needs to be supported by a very strong risk management. But it's definitely a good start. Seasonality, which we're going to talk about in this webinar. I'm going to give you also a link of a website that does the job very, very well. And you can also look at the last 20 years of data for free, which is more or less what StockCharts gives you for a subscription. So that's certainly the way to go, or one way to look at price. I like to have multiple confirming conditions or group of traders supporting the position. So based on what I said here about smart money and dump money, I believe that in order to win in this game, we ought to stalk the smart money. And because they are the ones who establish the trends. And now you also understand why I like to call myself FIP stalker. I promise I don't stalk people. I only stalk price. But the whole idea here is to look at what and try to identify what are the areas that smart money is looking at, and then have some sort of mechanism to understand. And that's but this elements of this okay, and if techniques very well powered as well. All right. So, how many of you believe that the presence of algorithms and classes of algorithms in the market is overwhelming? And in fact, I will go to say that there are certain classes of algorithms that control high volume markets, believe it or not. Control does not mean that they define 100% of what happens in the market, but in specific conditions and trends, and also, excuse me, they can actually feel their presence in all time frames. So these are the numbers, and these numbers are not even up to date, but they give the picture. More than 80% of major futures market and equity were traded by algorithms in 2009. Imagine now, after 8 years, forex markets. 25% 2006, more than 50% in 2015, and in 17 that volume is continues increasing. And this is not high frequency trading. I want to make a clear distinction here. We're not talking about high frequency trading. We're talking about other classes of algorithms, and there may be hundreds, if not thousands of them. And in aggregate, they produce certain effects on market. The volume on options is also very, very high and growing. So the proof of the existence of algorithms is in price, and these are the sources I've used in the years to collect this data. And you can double check and review these sources. So what's the the effect that we have on price? I mean, in practice, what these algos are doing on price. And these algos are derived from program trading of the 80s, which is really a bunch of, initially was a bunch of techniques derived from the typical behavior that was known by big traders who, in the period between the later 70s and early 80s, have moved from the pit to the first and second floor where they were trading using computers. So algorithms bring about and enforce price reversal. And price reversals, it's all about trading. I believe it's all about price reversal. Okay, I mean, what I mean here is that whenever there is a trend, I want to try to identify where these areas are, and that's exactly what I do. One of the techniques I'm going to show you now. We identify areas using a variation of Fibonacci, and then once we see price in those areas, we want to use other techniques like the stalking timing and go down one or more time frames and see, basically in a nutshell, whether the participation of algorithms on the larger time frame in this area wins the participation of algorithms in the opposing counter trend move. So that's in a nutshell how I model algorithms in order to get lower risk probability entries. Okay, and I believe that's very, very important. The understanding what algorithms can do on price, again, enforce and bring about price reversal, enforce, start and maintain trends in all time frames. And again, I'm not, and I will not say that this happens in all markets. Volume, it's very, very important. If if you are prototyping and designing algorithms, keep in mind that there are many algorithms in the market that can only work with volume. And that's the reason why they also are very successful in all those areas and the juncture in the market where people are suffering. If someone sees a trend like this, okay, and now some people say, well, this market will continue going higher, but there is a structure in the market, so you continue going higher only after a correction. So whenever people enter, let's say here, and are underwater and suffering here, that's exactly what algorithms are looking for. Because if they are suffering at this point, they are ready to exit because clearly their timing was not good, and now they start believing that this market will keep moving lower. So what they do, these are the areas where people suffer the most, and these are also the areas where algorithms will be looking for volume, will be looking for people who want to exit because they were long and their timing was bad. So they are underwater at the moment, they're suffering, they're in pain, they want to exit, so they want to sell. And in this trend, the algorithms are looking to buy. They're looking to buy exactly at the points where people are suffering the most, they're in pain. I hope you'll get that. That's a very important concept. So algorithms also take levels relative to areas of participation. So relative to areas of participation means that if algorithms, let's say there is a trend and algorithms participate in this area here, right? Every time we identify this area here, automatically we also identify two targets, first and second target. And you'll be amazed how algorithms take profits with regularity one of these two targets. Okay, so again, point here, take profit at specific levels relative to the areas where the participation came in. Now, some methods to model effects of algorithm price only work on high volume market, and the Fib-Stalker methods that I use work on high volume markets, but also they are surprisingly simple. Now, I'm not going to talk about Fibonacci. Give me a yes if you have an understanding of Fibonacci or Fibonacci is. So I'm not going to. Adam says good. What about Al, Nick, Pat, Thomas? Tell me yes, no, maybe a little bit. I would like to know more. But I'm not going to, Thomas say yes, because Fibonacci numbers, I attended a few webinars of Fib. Very good. So thanks for sharing. And so you know what Fibonacci is, where it comes from, the sequence, the golden ratios, and how they are derived. The golden ratios are derived by dividing a number of the sequence for the subsequent and vice versa. The point is that there are also a lot of decisions that were made in the Fibonacci number just to, in my humble opinion, to actually spread the levels heavily. And Ali is saying levels are watched by market participants support, resistance plus stop loss and profit target. Yes, they are, but we also know very well that Fibonacci levels by themselves are reliable. We never know whether the market is going to stop at 26, the 38, the 50%, which is not even a Fibonacci number, and so on. Now, some numbers these days are very popular, 71 or 80%, 81%. I try to keep it all simple because the Fibonacci levels by themselves are not reliable. We need to be very, very careful in using them. And of course, there is risk management that goes hand to hand, stop loss, it goes hand to hand with Fibonacci. But the levels by themselves are not reliable. And I use Fibonacci in a way that helps me to frame a trend, not only to find a potential level of support or resistance. So Ali is saying, as soon as all levels, a level is clear, there is a probability that the next Fibonacci level might be triggered. Yes, there is a higher probability as you go, the further you go. But yet it's not as precise or reliable. The reliability of those levels change depending also on other factors, so whether we are able to identify if there is participation at any of those levels by large players, because that's what I'm interested. I'm not just interested in having the Fibonacci level drawn on my chart. I'm interested in drawing some of them on my chart, and that are very probable, and try to capture other ones using the way I trace sequences of Fibonacci, and I'm going to show. I'm going to talk about that, and then adding a mechanism that allows me to understand whether the big boys are entering within area. So if you ask me, I see in the common Fibonacci sequences a lot of uninvited guests. For example, we see square roots, and one should explain me what's the meaning, what's the semantics of square roots when it comes to Fibonacci levels or price levels. And there is no specific semantic, of course. And this is a tool that has been created to kind of capture potential different levels of retraces, but does not tell us which retraces happens more often. Actually, there is one retrace that happens more often. It's the halfway back, and there is a reason for that. and that's one of the numbers that I keep. I do not believe in the 100, 200, and 261.8% levels, as well as shallow retraces. I'm going to show you how we trade, how we capture shallow retraces. So as you can see here, there are a lot of numbers, but I throw away most of them, and I keep only 4 levels. So these are the numbers that I keep. Okay, I keep the 50%, 61%, the 127%. In reality, I use 123.6%. The reason I use this is because by observation and thanks to the help of other traders as well. I also keep 161.8%. This corresponds to the XOP target of Joe Di Napoli, but I don't believe we need the 26.1%. In fact, we can capture that number differently. So as you can see, only 4 numbers. I wrote extensively about this. I wrote on the IFTA Italian Fiat Quaderno about this, and you'll find also May 2014, if you go back in the FX Street library, you'll find these additional new uses of Fibonacci model markets. Give me a yes if you ever saw that presentation. If you haven't, my suggestion is that you go and watch that. And I talk extensively and criticize the use of the current use of Fibonacci numbers, and you can have a look at that. So let's very quickly look at how we model market price. One simple way, if we have a move A to B, we look at the 50% retrace. This is the area C, and if price gets between the 50%, 61.8% level and never breaks the 61.8% level, I will consider that area as an important area where I want to look for participation. Okay, so again, I only use the 4 levels. Now, notice that whenever I trace a 50% A to B, the 50% and 61% level identify the area where I want to get into action, where I'm looking for smart money to participate, but automatically there are 2 levels that are already identified. The first target, which is the 23.6%, and the second target, which is the 61.8%. Basically, 23.6% means 23.6 of the distance between A and B above B, and minus 61.8% means 61.8% of the distance between A and B above B. Okay, so this chart here is not in scale, but it shows you that whenever you make one trace, you have all these levels already identified. You trace from A to B, you only consider 4 levels: entry area, first target, second target. That's it. And you'll keep using these levels here. Okay. So if price gets into D, there could be some profit taking. That if the price gets extended, it could get to the second target and even higher of the second target. Now, if you know that there is a level that algorithms are watching closely, and would be this level here, would you really trade breakouts? And this has been one of the problems I had in the past. Because imagine the market coming back to C and then breaking above B. How many of you have ever traded breakouts? Give me a yes if you did. I certainly did. Give me a yes if you traded breakouts in the past. Looks like you understand and masterized Fibonacci well. Well, you could say that, I've been studying Fibonacci since 2000s and 2008, 2009, I started with other traders as well. Yes, so you trade a breakout 1 year ago, a month ago, a breakout. I just want to show why trading breakout is it can be painful, and to me, it's not longer the right choice. Smart money enters here. And we have to enter together with smart money. I made this mistake a number of times, many times, many times, when I didn't know what I know now. So if we enter above B here, can you see how close is the first target? And that's the reason why very often, and I'm sure that all of you have found yourself in this situation, we're very, very happy the market goes above, and we are very happy, and we think we did the right thing. The point is that as soon as very often price gets into that first target, algorithms will start taking profits, right? And by taking profits, they might bring price below our entry price, because algos have entered here, not here. They want people to enter here because this is going to push the price to their targets. Okay, so this is just for you to put in the back of your mind, because these happen more often than not. And so here is there are a number of examples here, either on the larger time frame, and you have a 50% retrace, A to B, and this is the participation, 50% retrace. But you have this 50% again and again and again, long and short, within trends as well. For example, X, Y, W, there was a 50% there, first and second target. And even if you trade consistently into the first target, and even if you only trade the 50% retrace here into the first target, that gives you great opportunities for participation. Again, C, D, E right into that first target. That is just a small example here. These are examples dated now, but if you apply these methods on current markets, let's make an example. Yeah, we can use the euro dollar here, and recently, if you keep tracing your 50%, in some cases the market will not respect them. But if you keep tracing your 50%, the market will get into this area. And if there is participation, again, we never blindly buy these levels. I have a technique that I use to test whether there is participation coming from this area. And you can have, the market moving into first and second target. It's not a case that this market is currently taking profits and kind of slowing down around the second target, 112.51. It is another 50% retrace. And of course, there are within this trend, with this 50%, there are inner measure moves that can be identified before and after the fact. And now you start also seeing moves that actually start within areas where this smart money comes in. And we'll talk about this later on. For now, I just want to focus on simple models you can use to model price. Notice that here we're not only trying to model a price. Sorry, I wanted to look at the New Zealand US dollar. We're not only trying to model price here and to identify opportunities for an entry. We attempt to model the whole price structure. Okay, so another typical example came middle of 2015 here on the weekly time frame. For the New Zealand US dollar, there was a 50% retrace from the lows in 2000s to the highs in 2011. So believe it or not, these levels can come into play after years and years on larger time frames. Okay, so once we had this participation here, what we are looking for, we're looking at a first target on this large time frame, which is very much higher. Okay, now on these large time frames, we can take position. And we can use this to study what happens next, to understand how we place our trades within this context. When we move to the daily here, yes, but that's not that's not only it. Ali is saying incredible 50% support. 50% is something that you have to watch very, very closely, okay? But look at recently the move higher that we had in this market. First of all, you have to now start understanding that 50% is pretty important, okay? Also within the move. So we have a larger move here, which is the 50% that's traded here. Is this level here, and within that level we have another 50%. And now within the level, within that move that started at that 50% level, look at what we have. We have sequences of measured moves, okay? And in fact, we have a 50% here, and the market gets to the first and second target, and now the market starts trading in extensions, and we have ways to model that. Here we go. That's the area of participation, okay? And we can see that much better on a smaller time frame here, which is the 4 hour. You have first measured move, and 50% measured move, first and second target. If the market gets to the second target, we actually trade a highs twice. Notice that we can trace this before the fact. I'm showing it to you now after the fact, but we captured this analysis and this level well in advance, because when the price closes here to the second target, you will start tracing from highs to high and any new high that you get. So as I mentioned before, when we can identify this level, in this specific case, 2, 3, 4, 5 for us, that's 20 hours. Okay, so we on why we model. So I just want to this presentation showing you the methods as well. I teach that as well. Now, remember that we say the 50%, when price gets into that second target, is giving us an indication that the market is extended. So if the market is extended, we have to start the market differently. We have to start modeling. We know very, very well that extended market retraces less. Okay, so how do we do that? If the market gets to the second target, and let's say that H is the second target, I'm not gonna trade like most of F to H, or even from a lower level to H and try to find confluence of level is not reliable. How do you think that this is just this is a joke? This is just a flown concept, actually. So don't don't fall in that trap. Okay. Now, whenever price gets into a second target, the retraces tend to be shallower. So in order to identify the next area of potential participation, I don't trace from, like many do, from lows to highs. I trace from highs to highs. And that gives us shallow retraces. And now you understand very well that this helps us capturing the 38.6%, the 26.6%, all the shallow retraces are captured like this. They're not captured by tracing, in my humble by blindly. Okay, so we what the market is doing. And again, as you see, the elegance and beauty of this model that you keep using, this is 23 to 161.8%. You keep using the same levels. Okay, and that's the beauty of it. And an example of a market, another example of a market measure move 50% retraces second target. Once it's got into the second target, this market is extended. We cannot model simply by tracing from lows to highs. Okay, we need to be smarter, and one way to do that is to use the high to capture an extension move. All right, and I think I've showed you this live. And by the way, we captured this setup here, this trade before the fact. Okay, so and as you can see here, the market then continues higher and goes into the first and second target. So these some of the models that we use. I will close it here for now. I hope this was interesting. We are going to add more examples of this in part 2 time. And we'll talk about dump money. Dump money as well, and we put everything together. And plus, once we have seasonality, we really have a strong and robust system that you can use to a very okay. So thanks for you. You want to go and drill down into the time frame, because there are many more. There is a 150% here I showed you, which leads to a sequence of measure move, a trend that develops. So thanks for being here. Very nice presentation. Congrats. Yes, thanks. Okay, thank you. So very good. So thanks for being here. I hope this was interesting. Be back for part 2. And I'm going to give you some wow moments when you'll be back in 2 weeks time, and we might extend this presentation in 3 parts as well. So thank you very much, and have a great day and continuation of the week. Okay, bye now.